Hey, everybody. Welcome to the podcast. Ernest, good to see you.
Good to see you.
What's going on? Are you excited for the Christmas holidays?
As much as I could be.
I'm excited. You know, watching the stock market go up and down this year, you need a little break from the ups and downs of stock markets and all the craziness that we've seen. There's been a lot of highlights and lowlights in 2023. I think we'll talk about them and maybe a little bit of outlook for 2024 as well. And yeah, let's get into it. What do you want to touch on first?
Well, this was just a crazy year.
Yeah.
If you remember, we started the year, everybody was freaking out about inflation, about whether rates were going to go to 12%.
Yeah. Remember there was one guy on CNBC that said that interest rates are going to go to 13%. Like, you know, that's, I think the crazier things you say, just, I guess that generates the headlines, right?
Exactly.
Yeah.
But as we find out, you know, you don't want to react based on the common narrative at the time.
Yeah.
And that's what happened. I think the S&P 500 is up 23% year to date. We'll see what happens in the last 2 weeks of the year.
Yeah.
But all signs point to a good finish.
Do you remember? So let's go through some of the crazy stuff there's been upsetting stuff. The bad stuff that happened in 2023. But one of the things that just like pop into my mind was remember we had a banking crisis? People were worried that there was going to be a run on banks in the US. We had two, I wouldn't call them major banks. They were more niche banks that failed. And after that, people thought Charles Schwab was going to fail and this was going to cause problems for the rest of the banks.
I forgot that was this year.
Yeah. So what's the highlight and lowlights for you? What are things that stand out for you in terms of crazy stuff that's happened in 23?
Well, this was a really crazy year.
Yeah.
And like I think in fairness, like every year is kind of crazy in its own way. But this year you had AI, you had and what's going to happen to society from AI.
Yeah. What is going to happen with society from AI? We don't know yet.
Don't know.
No.
We had geopolitical issues,
Yeah.
certainly with Israel and ongoing conflicts with Ukraine.
Yeah.
We have Ozempic and GLP-1s and whether obesity is done for good. So, and then we had ongoing inflation questions, right? Mm-hmm. Which is in my view what is largely driving the stock market.
So, I mean, there's always going to be macro things, but you know, when you boil it down, what's really important to the markets? Obviously, it's interest rates, it's inflation, and it's corporate earnings, right? Don't those three things ultimately matter the most over the long term?
That's exactly right.
Yeah.
And I think people forget that, you know, like we've talked about this a lot on the podcast. Tech stocks have far outperformed other sectors this year, right? But people forget that tech stocks far underperformed in 2022. So in my view, a large portion of this reversal is just a catch up of what happened in the prior year.
So this year was all about, in the headlines, of course, all about the Magnificent Seven. And for Canadian investors, I would think the only name that did as well is probably Shopify, right? In terms of the performance. At one point, Ernest, in the TSX, was the commodity names that were doing incredible, which was weird because if you thought higher interest rates do bring on a slowdown, why are commodity prices going up? One of the things that stood out for me is just the crazy move in interest rates and watching the 10-year bond. At the end of the day, the 10-year bond really tells you the health and wealth of the economy and what stock markets should be priced to. Or if the 10-year government bond is rising and it makes it more attractive, then maybe stocks are less attractive. And at one point, the 10-year bond in the U.S. rose to 5%. It didn't stay there very long, though. Today, it's under 4%. So, even watching interest rates move like small cap stocks has been quite fascinating.
And it's still not really clear to me whether the inflation that we saw in 22
Yeah.
was due to one-time factors like supply chain, people coming out again from COVID lockdowns, or was it due to other factors?
Yeah.
Right, like low interest rates from before. It's really hard to kind of parse these things out, but I think what's encouraging for everybody is that the number seems certainly to be coming down.
So a lot of stuff was thrown at us this year. Some of the things we probably even forgot that about the bad news. So as a long-term investor, which we are, and that's the name of the podcast, what lessons do you think you can learn from the volatility, from the bad news, from stocks getting crushed in 2022 and many stocks recovering crazy in 2023? What's the takeaway?
I think the main takeaway is that you have to remain invested. Over the long term, stocks tend to go up, right? This has been true for over 100 years. And there's always things to be worried about, right? But over the long term, like stocks tend to go up.
Yeah.
Because companies make money.
Once you lose all your hair, there's fewer things to worry about. But yeah.
Companies are trying to improve their productivity. They invest in their businesses and they make money. So I think to add on to that, you don't want to sell, especially at a time when everybody is telling you that it's time to sell.
Why do people want to sell though? Like, is it the fear of the stock prices going down, the narratives, the headlines at the time? Just a combination of those things. Just our monkey brains can't handle those big fears.
I think that selling always sounds smart, right? And selling at the bottom always sounds smart as well, although you never know it's the bottom until after the fact. When you're selling, there's probably something to worry about, right? Like whether it be an individual stock, whether it be the stock market as a whole, right? Like if you, and then to add to that, if you sell, you probably get a tax loss as well.
Yeah.
So that certainly helps you feel better. But I think what often ends up happening is that you're thinking the same thing as everybody else.
You are.
And you end up selling at the bottom.
So I think one of the things that we tried to focus on here for our clients in 2023 was really making fewer, better decisions. We have had as investors, and I know clients, I mean, we're all in the same boat. I own the same stocks. We own the same stocks as our clients. We've also had to put up with so much uncertainty, really, coming out from 2020 to today, just nonstop. But I think one of the things that we learned and put into practice is, we see that things are going to worsen in this sector. It's clear to everybody. It's also clear that the stock price has fallen as a result. You and I talked about this yesterday. The home building, the home renovation companies, stocks involved in that type of industry are some of the best performers in 2023. Our clients own shares of Watsco. I don't think we've ever talked about Watsco on the podcast, or Floor and Decor, right? These are two names that they're hurt by rising interest rates. The consumer doesn't have disposable income to spend money on those type of things. Yet those stocks are terrific performers, even though as rates go up, it could hurt their businesses in the short term.
I think what we also realized this year is that if you own a good business, which we think we do, we think all of our businesses that we own are good businesses.
Yeah.
They are going to be all right in the end, right? A good example is Netflix, right? Netflix has been a super volatile stock, right? Stock up 100% and down 80% and then up another 200%, something like that.
Insane.
In 2022, I think there was definitely a lot of things to worry about Netflix, right? Growth was slowing down. And I think they were losing a little bit of subscribers. They admitted that they raised prices too much. I think their competitors were all launching streaming services.
Yep. No, it was a tough time, and it was reflected in the stock price, as you said.
And they had to change their business model.
Yeah.
They started selling ads. I think they were cracking down on password sharing.
Mm-hmm.
But I think what ended up happening is that all of the things that Netflix was faced by their competitors as well.
Yeah.
And Netflix they were the largest. They were the only profitable player. And as a result, all their competitors also had to pull back. And Netflix is a stronger company today.
Yeah. So that really goes into our theme. What we're trying to achieve for our clients is owning companies that have great balance sheets, have strong management, that are adaptable, that are flexible, that are winners in their industry, in their market, and that can come out of tough times even stronger. And I think that's been proven out with a lot of our names in 2023. They always say that the great returns come from planting the seeds in tough times. And there were tough times in 2022 and 2023. And these companies that I think we own, a lot of them have pivoted and made themselves stronger heading into whatever we're heading into.
Yeah, I would say that certainly we didn't expect the stock price movements that we've seen for some of the companies that we've owned, but we were very confident that they were in good shape going forward.
I said to clients last year, at the worst of it, I said, from our experience, it will probably take around a couple of years to recover. I was shocked that we recovered in a year. Goes to show it's impossible to time. Could have easily gone down in another world, in another dimension, but that's how things worked. But I'm confident, as you said, over the long term, good quality companies, stock market tends to go up. So remain invested is absolutely the correct approach. Obviously, you have to add a caveat there: remain invested in good things.
Yes, and I think that's exactly right. Like, there's a lot of companies out there, and they were down significantly in 2022, and then up maybe 100 or 200% off the bottom, but still down 80% from the high. And these are generally unprofitable, money-losing, like cash-burning companies. We don't really play in that space. So I think our portfolio is positioned fine. Yeah.
Well, so we're happy about this year. We're heading into 2024. Obviously, I see so many people making their predictions about 2024, strategists telling us what they think the S&P 500 should trade at. I mean, it's all nonsense, kind of, because I mean, as humans, we have to, we can't just walk into any situation without a plan. And so I get why people want to predict what markets are going to do or how should we position. But for long-term investors, that shouldn't matter at all, right? And of course, none of us are going to be able to predict the bad unknown stuff that would happen anyways to our portfolios. You and I can sit right here and parrot what everybody else is going to say. Yeah, rates are coming down, inflation coming down, commodities are coming down, the market looks good, blah, blah, blah. Maybe we'll go up. You're probably right because stock markets tend to go up, but outlooks are tough.
And I think part of the beauty of owning good companies is that they tend to do well in good and bad times.
Yeah.
In good times, everybody does well, so they're going to make a lot of money. In bad times, though, they tend to have stronger balance sheets. They tend to have the best margins. They tend to make the most money.
Give some examples.
So Netflix again,
yeah,
right? Like Netflix again, they don't have to cut content to the same degree that all their competitors have.
Yeah.
They don't have to lay off as many employees, right? They can continue to invest in their platform.
Yeah.
And as a result, they're in much better shape, I think, relative to the rest of the industry.
National Bank in Canada is another example. All the other Canadian banks have to lay off people. National Bank is like, we don't have to do layoffs. We'll have natural attrition. It's just the pattern recognition that you get from owning companies that are the market leaders, that have strong management, that invest for the long term. You just see it over and over again in so many different events when times are tough.
Yes, and I think that if like you said, we have no idea what the stock market's going to do next year.
Yeah.
But if the stock prices are down, then in worst case, these companies can just buy back stock at a cheaper price.
So before we get on to some other topics, let's just talk about, obviously a lot of our stocks did very well this year. You had a lot of those big tech companies go up 40, 50, 60, 70, 80%. I don't think anybody should expect, nor do we want, if Adobe goes up 80% next year or Apple goes up 70%, then it's just going to be silly valuation back to crazy levels. And then you're just setting yourself up for pain, the pain trade, because those stocks will eventually crash, right? Over the long term, stocks shouldn't really grow faster than their earnings. So I think we are at a place where, we have to recognize that some of our great businesses are now priced like they're great businesses, unlike 2022. What do you do there?
It's really challenging because generally most good companies their share prices tend to correlate with each other. So Adobe announced earnings yesterday. Adobe stock is up I think 80%.
It was up 80% year to date before today.
And I think there's a lot of company specific reasons why Adobe's stock is up so much, but if you compare Adobe to all other tech names, especially software type companies, very similar performance.
Yeah.
So, I mean, it to some extent, it didn't really matter whether you were buying Adobe or Workday or Intuit or any of these other types of large software companies.
These companies, as we've talked about in many of our podcasts, they tend to trade together with similar valuations because people, the computers, the algorithms figure out which companies are the best and price them accordingly until there's a specific issue where one of them no longer belongs in that bucket.
And the challenge is that as I look at the watch list that I have of all the good companies that I want to own, most of them are at all-time highs.
Yeah.
Right? None of them are trading at cheap valuations.
But
low multiples.
It's what you should expect when the market's at all-time highs. And that's the challenge of the markets.
What's cheap is companies with bad balance sheets.
Great.
Like commodity-related companies.
Yeah.
Like companies that just aren't that good.
Gross.
Right? And so to me, I'd rather still own a good company, even if it's a little bit expensive.
Yeah.
Rather than rotating into something that is fundamentally lower quality.
And you and I talked about this. It's much easier just to focus on owning a company and its culture, its management, its trying to predict what its earnings are going to do, and instead of trying to figure out what my neighbor is going to do with his or her stocks in the short term and where the neighbor is going to rotate into this or that and trying to be ahead of that game. That's just not helpful. It's not how we invest, right? So if, as you said, those so-called bad balance sheet companies do rally and do better in 2024, and our companies, because they've already recovered, don't do as well, so be it. Because over the long term, our companies who are having those great returns on invested capital, reinvesting in the right way, growing their top line faster, will eventually be worth and do better.
And at a certain point, you're just trying to time the market, right? And we all know that that's a fool's game. You can't do it successfully.
Timing the market is not just I'm going to get in or get out. It's also trying to time which stocks and sectors people are going to get into. Too impossible. So you drove to Michigan for pizza. So why don't you tell everybody about your little road trip?
So last Thursday actually, Domino's Pizza held an investor day. So companies from time to time, they'll hold these events where they'll gather all the analysts in the room. The CEO and other executives will go up on stage and talk a little bit about where they think the business is headed, what's their plan going forward. And companies do these for all sorts of reasons. Mm-hmm. Sometimes they think there's a misunderstanding about their business. Maybe sometimes they just want to pump the stock a little bit.
Sometimes there's the analysts turnover. There's new sell side analysts or buy side analysts that need to hear the story again and buy into the story.
Some companies do these every year.
Yeah.
So in Domino's case, they haven't done one since 2019.
Okay.
So 5 years. And since then, Domino's has obviously gone through quite a bit.
Yeah.
We had COVID, we had the supply chain and labor shortages, and then the CEO retired.
Yeah.
Right? So there's a new CEO in place. And I think so with this backdrop, right? Domino's used this opportunity to really explain why it's a good business.
Yeah.
Right? I think people were looking for more details around some of the specific initiatives that they've announced. So, like for example, they recently announced they were going to start selling pizza on Uber Eats.
Yeah.
Right? They didn't really talk a lot about that.
Why?
I think they wanted more to focus on the fact that Domino's at its core, it's just a good business, right? Like selling pizza is a good business. They have a strong brand name. They have the best franchisees.
They just know how to run their operations well.
Yeah.
And they've been doing this for a long time, and they keep learning and getting better, right?
Yes.
Yeah.
That's what happened.
Yeah.
They set out their new 5-year targets, which is 7% profit growth, which sounds pretty good to me.
Yeah.
And I think going forward, I think Domino's Pizza is in a pretty good place.
So if you get 7% profit growth over the next 5 years and some share buybacks and some dividend increases, you can get a pretty good return owning Domino's Pizza from here.
Yeah, and I think
Yeah.
I think one of the things that people don't maybe realize
Yeah.
intuitively is that Domino's is a fantastic business, right? Like, yeah, you don't necessarily like the taste of their pizza or think it's not very healthy.
You get what you pay for. You're not buying, fancy pizza from a special pizza oven with special sauce and, certified by Italian cooks. It's fast food pizza.
And Domino's is just clipping money.
Yeah.
They just charge a royalty. It's basically like free money, right? They have a very steady stream of cash flow, and they give it back to shareholders.
So going there, did you get to try any pizza?
They did.
What did you get to try?
They served every menu item that they have.
Uh-huh.
So not obviously not every single pizza combination you can have, but they served every menu item that they have. So one of the things that I tried that I really liked was their pepperoni cheesy bread.
Pepperoni. So what is that? Is it, okay, it's like a garlic bread type thing?
Yeah, it's basically like a garlic bread that has pepperoni stuffed inside.
Sounds yummy. And is this available?
You sounded sarcastic.
Yeah, no, it sounds good. Is this available in Canada and the US?
It is.
Yeah.
It is.
Okay.
But I think more important than the food was that during the investor day, I think they really tried to focus on the technology that they were investing in, right? Because pizza fundamentally, it's not like whether you order Domino's or Pizza or Pizza Nova.
Yeah.
It's not really about whether you think Domino's has better pizza, right? You're buying it for a birthday party.
Yeah.
You're buying it for your Super Bowl night.
Cheap and fast and no mistakes.
Right?
Yeah.
And so the key is that it's as easy to order as possible.
Yeah.
Right? And that's really what Domino's is working on.
If you're a technology company, if your website doesn't load in 2 seconds, if you don't have all the information for me quickly and I can order and make it easy, I'm never going to go to your website again, never going to do it again. So that Domino's gets that.
So one of the things that they're doing, for example, is that they made a new machine, right? Like it's a machine that can stretch dough without needing another employee.
So they used to have a guy throwing the pizza up and stretching the dough. That what used to be the old way of doing things.
Exactly.
And now they got a machine.
Now it's a machine that can, press it immediately.
And so is Domino's going to buy that machine for every store, or the franchise owner has to buy it?
The franchisees are going to buy it.
But it's technology. They'll save money and time, and productivity will go up as a result.
And another thing that they're doing is now Domino's can predict whether you're going to order a pizza and start making it before you even check out.
I'm hungry right now. Did they know I was hungry? Yeah.
Maybe one day.
Okay.
With AI, maybe.
Yeah. Okay.
But that's the kind of thing
cool.
that Domino's is working on. And
That sounds cool.
I think they're going to be fine.
You also went to another investor day one about labels.
Yeah, so CCL Industries, I didn't have to drive 4 hours
Yeah.
for this one. They held an investor day in Toronto yesterday. And the joke was that when I was first talking to you about podcast topics, I think you thought the dough stretcher was too boring for the audience.
It is boring, but it is interesting to those who are long-term investors that can see that this dough stretcher is going to make Domino's a fortune.
So if you thought the dough stretcher was boring,
Yeah.
then wait till you find out about labels,
Yeah.
right? Because
They got a better way of making things stick.
no, so that's the thing about
Yeah.
labels is that you don't really think about labels, right?
No.
But they are a part of almost everything that you do.
It's a gigantic industry. It's multi-$100 billion industry of labels. Yeah.
And for CCL's case in particular, they haven't done an investor day since 2010.
Okay.
I'm not really sure why they decided to do it now. I think maybe they felt the stock price hasn't really gone anywhere for 7 years.
That's correct.
And so maybe they felt like they needed to get the story out a little bit better. But they basically, every division leader came out and gave a little presentation on what their business does, where they think it's going. Like, for example, did you actually know there's a lot of innovation in labels?
I did not know that.
So, for example, right? One of the challenges with recycling plastic beverage containers
Okay.
is that the label cannot be separated from the plastic.
Okay.
And so CCL has invented a new type of label that can be, that floats to the top when you're trying to recycle plastic bottles, right?
Brilliant.
And this is a big deal.
Yeah.
Because now the bottles can be recycled, right? And they expect this kind of thing to help them gain market share. And that's the kind of thing that like we expect most of our companies to be doing, thinking of creative ways to grow their business and make new products.
Absolutely. It's not just a flashing price on your screen. There's a real business behind these things. So your takeaway from CCL, like Domino's gave targets on 5-year growth. What did CCL say about their business and what they're thinking going forward? Because it has been a rocky few years.
So one of the jokes about these investor days is that, like all this stuff that they're doing is great, right? Like it's all nice and fine.
Yeah.
But what everybody wants is the guidance, right? Like they're waiting for the CFO to give you what we think revenues and profits EPS is going to be in year 5.
Yeah.
Right.
And just like outlooks and of what's going to happen in the stock market in 2024, the visibility as to what your revenues are going to be 3 years and 5 years out is very hard.
And that's what Domino's gave, right?
Yeah.
So the CEO came up, he gave his intro, said, "Welcome to Domino's. Here's our 5-year targets."
Yeah.
And then, we can go.
Yeah.
We can go home.
Yeah.
To some extent.
Yeah.
Right. CCL didn't do that.
Made you wait.
They didn't give any guidance specifically, but they did say, yeah, maybe we can do $10 billion in revenues in 5 to 7 years.
And it's a $6+ billion revenue company. Now, this is not a fast growing business, but that kind of target is pretty enticing, especially because CCL is a great capital allocator and they're great at improving margins every year and free cash flow. So if the business is going to grow top line that quickly over a 5-year period, I think you're going to do pretty well in the stock here.
Right.
Yeah.
And what's funny is that right after, because the CFO came up and he said, we think we're going to continue to do what we do. And then that's not really what analysts are looking for.
Yeah. Yeah.
Then the CEO came up and said, we think we can eventually be a $10 billion company in the medium term.
Yeah.
And then all the analysts' hands shot up.
Yeah.
What does medium term mean?
Yeah.
Like, how much organic growth do you think contributes to that?
Yeah. How are you going to do that? Because you haven't done that in the past 5 years. And where's that going to come from? Yeah.
Yeah. And so in any case, like, feel comfortable that CCL stock is undervalued.
Yeah.
And that their strategy, it makes sense.
So the value of going to these things or participating, like clients always ask, do you guys speak to management? Do you go to management events? The value is, if you're a long-term investor, yes, you have to know what's going on with the companies. And the more time you spend with the companies, learning from the people who run the businesses, the better you understand them and the better confidence you get in holding them for the long term. Am I correct?
That's right. And I think, yeah, you can watch them online. Like anybody can watch them online. The real value in going in person is that you can talk to the management, right? You can talk to the executives who are running these things. So like yesterday, I was having a discussion with the head of one of the divisions of CCL about printed batteries, right? Did you know printed batteries were a thing?
I don't even know what a printed battery is, but
it's a battery that you print.
Okay.
Right? And
That's
there's
cool.
all sorts of applications that are maybe beyond the discussion of this podcast.
That would be extremely boring for the podcast. But yes, you're having discussion with him, and why was that discussion meaningful?
It's because you wouldn't have any other chance to do this, right?
Exactly. A meeting with the head of a department. Usually it's just the press secretary or the IR person or CEO or CFO who talks about the company on the conference calls.
Exactly.
Yeah.
And so that's why we try to go to as many as we can.
So just to finish off here, we launched a podcast in 2023, Ernest, and we've had phenomenal growth, and we really appreciate everybody following us and giving feedback. And we always love your 5-star reviews on Apple and Spotify or wherever you follow the podcast. And our goal for 2024 is to try and do one a week. We'll do our best. This will be the last podcast of 2023. We'll be back in 2024, and we'll be doing these podcasts as on video as well. That's exciting for us, and we really appreciate. And spread the word. Any feedback for us, we'd appreciate it. And we're just going to keep on talking and trying to convince everybody to own great businesses and be a long-term investor. So I wish everybody happy holidays. We'll be right back at it in January. Anything you want to finish off with?
Nope.
Sounds good. Thanks so much for joining us. Take care.